Rob, appreciate you joining us here on London Calling. Let me start by asking you about your view on India, because your report clearly spells out a bull case for India over the next 5 years. What makes you so confident and optimistic about the India growth story, specifically the equity markets?
Well, I guess we always invest with a long-term time horizon, and one of the things we like about India and have done for many years is the long-term thematic exposure. So very good population dynamics, a lot of potential in terms of catch-up productivity, a lot of low-hanging fruit in the economy. And the really good thing is India's also just coming out of the bottom of a credit cycle. So India's obviously had a few tougher years economically. We started our position back in 2011. And we're quite happy about investing on a 5 or 10 year horizon, but we're still in a kind of grind out of the bottom of the economy, and starting to see some more positive signs. The investment thesis for us is quite straightforward. There's a lot of pent up demand, there's a lot of gummed up infrastructure. The previous government had done a pretty poor job, and the bureaucracy had ground things to a halt, particularly in the power sector. And now the new government, I mean, really we thought any change in government was likely to improve that, but clearly the Modi government is moving things on. Sometimes people get a bit too optimistic about it happening too quickly, but we're quite happy about the way things are progressing. And the news this morning on the SEBs, the power sector, is very positive and is another case in point.
So given the fact that you feel that the story at this point in time in India is compelling, the reform agenda is moving, albeit patchy in fits and starts, but in terms of valuations, how do you read Indian valuations today? And even in terms of sectoral allocations or country-specific allocations, India is your highest in terms of allocations at 22.7%, I believe.
We actually have just under 30% of our global emerging market portfolio invested in India, which is more than 20% overweight. That's actually increased slightly over the last few years, but we're pretty happy about that. What we do have is a very different allocation to the market as a whole, so we're very, very skewed towards the consumer side of things. And by consumer, I would include the Maruti Suzukis, so the autos, the two-wheelers, as well as broader consumer, so staples, but quite a lot of discretionary element to that. A little bit of banking exposure, and not so much of the infrastructure and heavy industry. We think that comes later on. It's not just a cyclical rebound of the high beta industries. It's more of a grinding out consumer recovery. And what we like is actually, if you think about the valuations, we think on a long-term basis, a lot of people look at PE ratios, which are quite short-term in nature, whereas actually the margins, the profit margins in India are relatively suppressed at the moment, and the growth potential is very good. And if you build in the fact you could maybe expand from, for a typical company, 10% margins to 15% margins, 10% growth could go to 30% growth, and then you get a re-rating on the back of that as well. Suddenly you're sitting on 50–100% upside for quite a few companies with actually quite a good risk profile, and with a reasonable amount of conviction about the potential of that happening.